Hello, hello! There has been a storm in the past few weeks about Netflix wanting to acquire Warner Bros. And you may have heard about Paramount entering the picture as well and actually offering more money for the potential acquisition. And Warner Bros. Actually deciding that they wanted to go with Netflix instead of Paramount, even though Paramount were willing to spend like $30 billion plus, more than that actually. So you may be wondering why is this happening and why Warner Bros. Are not going with Paramount and they decide on Netflix. Well, what's the reason behind all this? So in this video, we're going to examine all three companies here in a little bit more detail, and you will see what has been going on in detail. Now, using the tool, we are actually going to discover everything about these potential negotiations without having any knowledge, any outside knowledge right now. So we're just going to fire up the tool and we're going to discover everything as we go. The first thing is the company that is actually going to be sold, Warner Bros. Discovery. What's up with this company? Let's take a look at their corporate history first. Actually, the most important thing is the profile, I suppose. So you can kind of see what kind of products they make, services for the most part. And you're going to see they have HBO, CNN, TNT, and very, very well-known streaming services. Now, Netflix wanted to buy part of Warner Bros. And actually have Warner Bros. Spin off some non-profitable parts like TV channels that they own. So that was the package that Netflix was offering. On the other hand, Paramount was offering the full thing, like they wanted to buy the full company for more than $100 billion, while Warner Bros. Offer was for about 83, I believe, dollars. You can see it here, 82.7. And you may be wondering why 72 is the equity value and why the enterprise value is 82.7. Well, the difference here is it's adding debt to that. So how much money are we going to be paying to buy the company plus the debt that we inherit that the company already had? Practically speaking, that's what the enterprise value is telling us. If I acquire the company, okay, I pay some money to acquire it and maybe some shares of Netflix to the current shareholders, but also I'm inheriting debt, and this is money that I'm gonna be owing. So it has to be added. So the value of the deal is 83 billion, the full value. Now let's go back. You will see here, if we go to corporate history, very, very interesting things about what has been going on with this company. Notice the business combination here. What has been going on? AT&T. So AT&T used to own all these products that you see here from Warner Bros. Discovery. And notice that it used to be called Warner Media. And what they did is they created a SpinCo, and a company, sort of like a cell company named SpinCo, and transferred everything to a new entity later. As they offloaded things to Discovery because they couldn't make things work, and Discovery tried to do that later. So this is basically, think about it like as a legal structure that they are using to alleviate some taxes. This is the main reason for using a SPAC here, sort of like a SPAC, it's not exactly that. But this is why they do this. But as you can understand, what you first see here is the fact that back in 2022, there hasn't been that much time. They actually basically got rid of the company, is what happened here. And so Discovery entered the fray, and they were actually responsible for what has been happening with the company after that. So this was the first, business combination, the first corporate history event that really matters here back in 2022. Now, if you take a look at the key events here, there are a lot of events going on. I kind of like to use compact because it gives me a very, very nice summary here that I can very quickly see things here. And notice over here in June 26, that's like a few months ago, Warner Bros. Discovery secures a 17 billion bridge loan. Very interesting here because they agreed to a loan, as you'll see, $18 billion loan. But what is extremely important here is this fact. The loan is secured by most personal property and guaranteed. Basically meaning that if they cannot service the loan, they are going to have to sell parts of the company. They're going to have to liquidate assets of the company in order to be able to give it back to the bank. And so this is extremely an extremely problematic situation that Netflix knew of. And this is what they were thinking. Okay, this company has trouble, but they also have products that we care about, and we can enlarge our library. We could potentially buy them, and we will get rid of some stuff. Okay, they don't work, but they're in a situation that they kind of potentially have to sell. This is what Netflix thought, and this is why they offered the $83 billion that they offered next. Okay, so after that, what has been going on with the whole process? As investors now, we care to understand what has been going on with the company. And again, if I go back to Compact over here, you will see that the company had to have some restructures. Notice this one here. And notice this was December 14, 2022. This was basically after the new company was formulated. Remember when AT&T got rid of it? Discovery raises restructuring charges to $4 to $5 billion. And you will notice that these are actually write-offs, content write-offs. Basically meaning that the company was already doing bad at the moment they purchased it. They actually bought it. And at the very first few months, they actually had to write off content. Which is basically saying that, okay, these are not doing well, so we need to take some hit in our books, is what this is saying. Now, if we take a look at the AI deep dive, which gives us incredible insights here about the company's financials and what has been going on in the most recent quarter, notice this. We have things about the Netflix wanting to buy, and this is how much they're willing to actually give to every investor of the company. That's like 23.25 cash plus Netflix stock. So the investors that are going to be agreeing to that, they're going to be getting that if the company is going to be bought. And you will see here the other very interesting topics. The loan that I spoke of. Remember, refinance or sell assets, extremely important. They have trouble with making money, and they have a loan that it's kind of difficult to service for them. And even worse is the fact that audiences of TV, for instance, you'll see here, are collapsing. Old school TV is a nosedive. And notice that this gives you the full details, drop 22%. We can actually use the investor view if you're more savvy and you want to look at more details about EBITDA, what has been going on exactly, the decline in advertising, extremely important. And things have been going bad. And this is why Netflix didn't really want to buy this part of the business, right? And so subs, on the other hand, are up, but revenue per user is down, the ARPU, which is very important because you can have subscriber growth, but if they are not making money per subscriber, or the subscriber money per subscriber is down, that's actually really not great for the company's overall financials. And again, obviously, Netflix were aware of all these situations about the company, and this is why now they are like, okay, maybe we can actually get them to sell to us, and that's why they offered the money. Now you may be thinking, okay, they have some debt, okay, maybe their financials are not that great, maybe some things are dropping here and there, but did they really have that much trouble that they needed to sell? I'm glad you asked, because we can take a look at the Q&A analysis here, which gives us details about specific parts of the company. And let's take a look at downgrade. That's extremely important. Why? Because when you have downgrades of a company, you're actually increasing their credit risk. So now, if they want to refinance debt, for example, they're going to have to pay higher interest. That's really problematic for a company that has trouble paying their debts already, right? Which we have already established here. And you will see here that rating agency downgrades materially increase funding costs or limit access to market, is what the question is asking. And downgrades in 2025 increased refinancing risk and borrowing costs for WBD. And so Monitor is the investor action monitor rating agency commentary and changes, because obviously this can cause big issues, as Moody's and Fitch have downgraded the company while they have a $16 billion bridge loan. This is extremely useful here, right? With the questions and answers gives you the full picture. So that's extremely important. You're seeing how the company is getting desperate, right? You're actually seeing it with text. We don't even have to take a look at the numbers yet, but we can, and we will. Let's take a little bit of a look at the numbers. What is going on with the company? Because remember, we have numbers here, but it's nice to be able to tell a story with text as well. Very useful. Now, the numbers of the company, notice here, the P ratio is pretty high. Outstanding rares are getting much, much higher. I think it's extremely high because there was a merger at some point, obviously. But so you can see it here. This is basically when the merger happened. This is very normal, but they haven't been actually issuing many shares, frankly speaking. This is when the actual merger happened. So there was basically a new structure here. So that makes sense. But on the other hand, they have debt here that keeps increasing. You'll see, and also the margins are kind of terrible. Like they're not doing great. The paper thin margins. Look at this, 1%, and going down. It's a roller coaster that is for the most part going down. So you can see a distressed company right now, right? It's pretty obvious over here just looking at these numbers. Okay, so next, what happened next? Now Netflix enters the picture. So let me load Netflix here. Netflix is like, okay, this is an interesting situation for us. Maybe we can actually buy the company, increase our offerings to our users. They have some good stuff. They have very, very well-known IPs. So it would be nice to be able to purchase them and integrate them to our pipelines. Why not? Now, Netflix is not the heaven that some people think it is, potentially, because they have their own troubles as well. Their P ratio, they are making obviously significantly more money and they have cash and not as much debt as Paramount or Warner Bros, obviously. But it's not like they have been doing terrific. They have been doing okay, even though their stock price is, definitely much higher than it should be, and it would be weird to buy right now. But they're making money. They have good margins and all that. Obviously, it's a depreciation-heavy company, or I should say amortization in this case, amortizing content. But, they have some normal and legit numbers here, as you can see. Everything is looking pretty okay. Nothing is like too red over here. Now, again, it's nice to be taking a look at the details of the company, and this is why I love having this in sort of like text, because you can see exactly what has been going on with the company. Obviously, everybody knows what Netflix is, so I don't really have to spend the time analyzing this. But what is worth taking a look at? Take a look at this one. So, Netflix secures $25 billion credit to fund Warner Bros. Discovery buyout. So basically, what they're going to be doing is getting a loan to be able to purchase the company. They're not going to be buying everything cash. So likely they're going to be getting a loan and also paying Netflix shares out of their treasury stock. And so you'll see they replaced a temporary bridge loan with a $5 billion. That's the loan that Warner Bros. Had, remember? With a $5 billion revolving credit and a $20 billion of delayed draw loans. So you see here that Netflix also wants to actually do the purchase with a big loan, and this is also what Paramount wants to do. However, there is a very important distinction here, super important. The fact that Paramount would be buying a leveraged, they would be doing a leveraged buyout, as we call it. So they will be basically getting a loan to be able to pay it without having the cash. And that is extremely important because it introduces danger to the current shareholders. So, for instance, think about it this way. If Netflix buys us, if I have a company and Netflix buys us and they give me Netflix shares, and now I have Netflix shares, I want Netflix to do well, right? So if Netflix owes $80 billion to a bank, while they're not making money as well, as we already established, actually we haven't seen it in detail, but Paramount is not doing great. Now we have a ton of risk here, and so why would we go with Paramount? You see, it's not so simple as just getting more money. It's not only about getting the more money, it's about security. And this is why they wanted to go with Warner Bros. Even though there were some objections as well from some of the board members that they want to go with Paramount because of the money, basically, the initial money at least. But it can be a trap, and that was the big reason, as we're going to see a little bit later when we're going to examine Paramount 2, which is also a pretty new company that was created very recently, Paramount Skydance. We will see that a little bit later. But you will see again, this gives you the AI deep dive gives you the top story, which for each company, which obviously for both companies is about the buyout. And so for Netflix is going to be the securing the loan for Warner Bros. Discovery buyout. But there is also other important things that kind of tell us a story about Netflix as well, concerns and things of that sort. And you will see, for instance, here, if you take a look at at this page, which gives us some nice information about what the company has been doing. That they have commitments for content commitments pretty much, so they have things to be paying, sort of like current liabilities in the next 12 months. So it's not like everything is roses for for Netflix here. And yeah, the tool creates some bull case, base case, bear case. There's a lot of things to potentially take a look at here. But if we go back and take a look at the quick text here, notice this, which is really important. Subscriber counts gone, investors left in the dark. Which was a thing that Netflix did, the fact that they stopped telling us how many people are watching. And so they are not actually reporting that any longer, which they are saying that sales are up like 17%, but as the tool points out, we don't know if that's from new fans or just forcing current members to pay more. And that is obviously really important because it's hard for us to see whether the company is actually growing or they're just getting more money out of current viewers, right? Really important here. And obviously the tool tells us about some other important things here that you need to know. For instance, this is a super important thing, the fact that they're paying for shows is eating up their cash and stock buybacks, because this is a content sort of like hunt here, because they have huge bills making all these shows, movies. This costs a ton of money. And if you go to investor here, you will also see it in more details, exactly what they have spent, with more investor language if you are interested in learning the finer details. So now I have selected Paramount Skydance, and you can see the company here. This is a brand new company. You'll see that right now they have a market capitalization of $13 billion. What the company is worth in the stock market right now. But notice that their full stock prices, even for 10 years ago, go back to August 2025 is when they actually were created. It's a brand new company, sort of like a merger. And how do we know this? If you take a look at the company profile, again, the tool provides you with all this information automatically and visually, so it's really fantastic. Now, Paramount combined with Skydance, and how do we know? You can see the merger that happened here. They used the Pluto Global, which is again sort of like a shell company for the merger. And Paramount Global and Skydance basically became a new entity, a new company here. So this is like a 5 months old company. Super brand new. But remember, $13 billion is their market cap, and they wanted to spend $108, I believe, billion to buy Warner Bros. So imagine that is like 8 times their market cap or so. So it's insane, right? That said, they also have a debt mountain, as you'll see here. So $13.6 billion in debt against the modest $3.3 billion cash pile. So imagine now that you are a Warner Bros. Board member and you are thinking about the two offers and you are like, okay, they are giving us more money, but what happens if they go bankrupt or they have trouble, servicing their debt? This is not great, and they also have near-term bills, like you see here, 4.2 billion near-term bills. That's like in the next few months, while they have a $3.3 billion cash pile. And you see that? And again, take a look at this dilution alarm. The tool is fantastic at telling you with headlines here very quickly what is going on. A tidal wave of new shares is hitting the float. See it as a story here. New shares and one powerful family are a risk for regular investors. So they gave 400 million shares to big investors, a right to buy $200 million more with guarantees. So this is, you see what is going on here, right? And they are talking about some complicated math, which is like accounting stuff here. And people units are up, but making money is the cuts. So they are getting more subscribers, which is good to see. And adding Skydance, what we talked about earlier, also means they have a bigger lineup of movies and shows, but a mountain of debt and not enough cushion. Super important, because the amount they owe is a huge $14 billion almost dollars. And now you can see the whole story unravel in front of you, even if you didn't know nothing, if you didn't know anything about none of these companies, frankly. Now you see exactly what has been going on with the buyout of Warner Bros., right? So you know the finer details without even having to take a look anywhere outside of the application here. And so now going back to the original question, does it make sense that they are accepting Netflix doing this, Netflix to buy Warner Bros. For $23.25 cash plus stock? Well, if you ask me, probably does, because being more secure in your selling the company is probably the better deal. Because I would be definitely scared of potentially selling to Paramount. Again, tons of debt, not doing that well. At least Netflix has the cushion; they have the cash. You can kind of see here as well. If I take a look at the income statement paints a better picture, obviously, about the company in comparison to like Paramount. It's much better. Actually, I wanted to show you Netflix, not Warner Bros. Here. Warner Bros. You'll see it's for the most part kind of the same thing, stable, but not really, having higher revenues. It's almost the same thing every year. But Netflix, take a look at the revenues here. They are increasing, not tremendously, but they are. And so, the company is doing okay. Net income increasing, and you'll see that their EBITDA here. Then again, the net income reconciliation for EBITDA as well is used. So you can kind of see that things are significantly better when compared to the other counterpart like Paramount, who is the other entity that potentially wanted to buy the company. And you will see that they are doing, for the most part, significantly better here, with retained earnings being increased through the years, telling you how much the company has been basically accumulating through the years. This is not actually their cash. This is how much they have been accumulating through the years, minus the dividends, for instance, that they have been paying to shareholders, is what you can extract from here. But you can clearly see that the company is doing significantly better, obviously, than a company that has like $13 billion in a market cap. Obviously, Netflix is much more expensive and has more potential. And again, I think this is why it makes significantly more sense. It's like at least almost 3 times what Paramount is. And obviously doing better too, the much bigger party. But do tell me what you think, guys, about their decision. Do you agree? Would you go with the more money and less security potentially? I'd like to hear your opinions about this. Thanks for watching the video. I hope you enjoyed it, and I'll see you in the next one. Bye bye.